For 1 minute, imagine you have a penny that doubles its value daily. How much will the worth become in a week or month or even a year? At the minimum, the value will stand close to $10 million. Now that is the power of compounding.
It was confounded by the fact that we could buy into these companies and in effect have an earnings yield of maybe 14% or something like that with dividends that would grow. They actually grew 70% during that time. And the people were investing their money at 0.25% or not.
The concept of compounding remains one of the most essential topics in finance. It explains how to earn interest on your interest, which makes your money grow rapidly in the long term. Compounding exposes the secret behind how a few people become wealthy despite making relatively small investments. Stay with us for the next few minutes as we explain how you can use this concept to make your money work for you and generate residual income. If you're ready, let's begin. Warren Buffett's view on compounding. Firstly, we will be discussing compounding with you through a step-by-step guide from the perspective of a renowned investor and one of the richest persons on the planet, Warren Buffett.
The biggest thing in making money is time. And I've had this long run, and so the compounding at the end turns into very big numbers. But you've got a tailwind in this country if you just own a cross-section of
Buffett. He attributes a large part of his success to the power of compounding. According to Buffett, compounding works best when given time, patience, and consistency. In an interview in Forbes magazine, Warren Buffett said, "My wealth has come from living in America, some lucky genes, and compound interest." Having started investing at a very young age, he emphasizes the importance of starting early in order to enjoy the full benefit of the power of compounding.
Well, I think there'll be a number of young people out there that are 8 or 10 years old now that will accomplish it, and there'll be a whole lot more that try it and don't.
Do you remember some of the pennies?
In another statement, he spoke about planning for the future. He said, and I quote, "Someone is sitting in the shade today because someone planted a tree long ago." This quote reflects the belief of the Oracle of Omaha that the decisions we make today will significantly impact our future financial well-being. Steps on how to use compounding. 1. Understand the basics. The first thing you need to know is to understand the concept. Compounding refers to the ability of an asset to generate earnings that are reinvested to generate further earnings. It is best to consider compounding like a snowball effect for your money. Then you need to understand the time factor. Acknowledging that time is your biggest ally when compounding is involved is important. Therefore, the earlier you start, the longer your money has to grow. The next thing is to start investing early. It doesn't matter how small the money you want to use for investment. Remember that the longer your money is in the market, the more time it has to compound.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor?
2. Set smart financial goals. Having clearly defined goals is one of the best ways to explore the power of compounding. Whether saving for retirement, purchasing a house, or funding your children's education, ensure your goals are realistic and measurable. You can start by creating a feasible budget and have the discipline to follow through. For example, create a budget that suits your basic needs and has room for emergencies.
You don't have to wait until everything stabilizes to start doing a budget. As a matter of fact, the only way it will stabilize is to do a budget this month and then do a budget next month.
The next step is to calculate the required amount you wish to invest. It is important to consider factors such as inflation, projected expenses, and emergencies to ensure you have a realistic target. Then it would help if you were consistent with your plan. You can consider automating your savings to make it more convenient for you. Finally, you have to set a specific time frame for each goal. Short-term goals might require a few years, while long-term goals may span decades. Also, remember that longer time frames allow compounding to work to your advantage. 3. Create investment strategies and use them. Now that you have clear goals, let's dive into investment strategies that can help you effectively leverage the power of compounding. First, you need to take advantage of diversification. Avoid the mistakes of relying on one investment portfolio.
Who's winning in this economy right now?
The rich. Guys like me. We have gone from having 93 billion, top 400, in 1982 to having 2.4 trillion, 25 for 1. People who it becomes a more and more specialized market economy. It was an agrarian economy a couple hundred years ago.
Diversifying your investment across various asset classes such as stocks, bonds, agricultural products, or real estate. With this, you will simultaneously reduce the risk and maximize potential returns on investment.
They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is.
Common examples of diversification include asset allocation across different asset categories, such as bonds, commodities, and precious metals. You can also consider geographic diversification, which allows you to invest in different regions and countries to spread risk across different economies. Another example of diversification is time diversification. The method is called dollar cost averaging, and it helps smooth out the effects of market volatility. This strategy allows you to use compounding over an extended period. In addition, you can utilize risk diversification as a strategy. This strategy allows you to invest in low-risk and high-risk assets to balance the overall risk of your portfolio. Low-risk assets such as government bonds or cash can provide stability, while higher-risk assets like stocks or real estate can offer higher returns.
Well, if you look at the present situation, we've talked about this before, that you get more for your money in stocks than bonds. That doesn't have to be the case.
In addition, company diversification allows you to invest in a diversified range of companies within each sector. This can be achieved by investing in different individual stocks or through mutual funds or exchange-traded funds, or ETFs, that provide exposure to a broader range of companies.
Well, you don't pick stocks, you pick companies.
Yeah, but when I was 11, I picked stocks. I had the whole wrong idea. I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read everything.
However, diversification does not guarantee profits or protect against losses, but it can help manage risk and potentially enhance returns by taking advantage of compounding over time. It is important to regularly review and rebalance your portfolio based on your risk tolerance, investment goals, and market conditions. Second, you should make regular contributions to your investments. For example, it can be through your individual retirement account or brokerage account. Remember, consistency is key. If it is possible, automate your contributions. Warren Buffett's advice is to never depend on a single income. Applying this wisdom to investments, we can adopt a similar approach through consistent, automated contributions. Automating your contributions will maintain consistency, eliminating the chance of forgetting or becoming swayed by market volatility. Third, keep investing the returns you earn on your investments through compounding. When you reinvest your investment earnings, you don't only accumulate a larger principal sum, but you also generate returns on your returns. In other words, you make money on your profits, leading to exponential growth. However, it would help if you had patience and discipline to make your reinvestment plan successful. Warren Buffett once said, "The stock market is designed to transfer money from the active to the patient." This statement emphasizes the importance of patience and discipline. Therefore, you must focus on your long-term investment goals and avoid impulsive decisions driven by short-term market fluctuations. Being patient and disciplined will help you harness the full potential of compounding. We can look at simple examples of successful reinvestment. A major example is Warren Buffett's investments in companies such as Coca-Cola and American Express.
I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million.
Both investments show how reinvesting dividends and capital gains can create substantial wealth over time. 4. Monitor and adjust. It is not enough to create different strategies and invest in various businesses. You must monitor and adjust your investment strategy as needed. Watch till the end of the video as we dive into the importance of monitoring and adjusting your investment in wealth creation. This process requires you to track the performance of your investment portfolio as often as possible. The next step is to adjust if certain investments are underperforming or become too dominant. You can also seek the advice of experts if needed. Monitoring your investments enables you to recognize opportunities to maximize your returns. Through careful observation of the market, you can spot favorable trends, timely entry points, and potentially lucrative options to invest in the future. Effective monitoring allows you to minimize risks by taking appropriate actions when market conditions suddenly change. You should remember that wealth creation is not just about making money, but safeguarding it too. Also, monitoring your investments helps you stay informed and adapt accordingly. The world of finance is constantly evolving through economic shifts, industry disputes, and emerging technologies which impact different sectors. Monitoring allows you to seize these opportunities to invest in companies at the forefront of these changes, ensuring your wealth growth aligns with the current market environment. Another importance of monitoring investments is that they help you evaluate tax strategies and optimize your financial decisions accordingly. Understanding tax implications can lead to significant savings and contribute to your overall wealth creation. By keeping track of changes in tax regulations and exploring tax-efficient investment options, you will increase your returns while keeping your tax burdens in check. Remember, Warren Buffett once said that risk comes from not knowing what you're doing. Monitoring your investment progress helps you make smart decisions. Ultimately, wealth creation is not a short-term endeavor. It's about securing a prosperous future. By consistently monitoring your investments, you can ensure that your financial goals align with your evolving needs and adapt as circumstances change. Frequent evaluations enable you to adjust your investment strategies, seize new opportunities, and protect your wealth for generations to come. 5. Embrace market changes. Renowned investor Warren Buffett once said, "Be careful when others are greedy, and be greedy when others are fearful." Market changes are an inherent part of investing. However, it would help if you didn't fear them. Instead, learn to embrace them. Let us show you why Warren Buffett thinks they are an opportunity. We can benefit from compounding in many ways by embracing market changes or fluctuations. First, the chance to buy low and sell high. A certain number of stocks lose their value every time the market fluctuates, so you can buy them at cheaper prices and sell them at higher prices later. Also, you can accumulate more assets at discounted prices, further amplifying the compounding effect. Consider for a moment that you bought a quality stock during a downturn and have it appreciate exponentially over the long term. The compounding effect can swiftly turn your small investment into a substantial sum. One of the best strategies for embracing market fluctuations is to focus on fundamental analysis. Don't let market fluctuations distract you from the long-term prospects of a solid business. As Warren Buffett advises, the stock market is a device for transferring money from the impatient to the patient. Summarily, embracing market fluctuations can be a game changer for long-term investors, especially when combined with the power of compounding. By following Warren Buffett's principles, we can take advantage of market volatility, buy undervalued assets, and allow our investments to grow exponentially over time. To help illustrate the power of compounding, let's look at a couple of real-life examples. Let's say you start investing $1,000 annually at a 10% annual return. After 10 years, you would have invested a total of $10,000. However, thanks to compounding, your investment could grow to over $17,000 in that time. If you were to invest that same $10,000 for 30 years with the same 10% return, you could potentially see your investment grow to a staggering $174,000. Warren Buffett's success story is living proof of the power of compounding. Therefore, you should embrace it and follow the steps explained here. Invest in your future now. If you like this video, give it a thumbs up, hit the notification icon, and subscribe to the channel for more videos.